Natural gas futures experienced slight gains in early Tuesday trading, with the August contract seeing a small uptick. This minor rise follows a substantial 17-cent decline the day before, signaling a market still contending with bearish influences. Prices plunged on Monday, driven by Freeport LNG's failure to resume operations over the weekend as many had expected, and by a slight cooling trend, particularly in the 5 to 10-day forecast period, as weather systems move across the central U.S. and Great Lakes. This will reduce cooling degree days to the lowest levels in many weeks, bringing them to near normal from Wednesday to Sunday, instead of the consistently above normal levels experienced throughout most of June and the first half of July. Today, traders are refocusing on LNG demand as Freeport LNG announced plans for a gradual restart this week. The terminal was set to receive approximately 370 million cubic feet per day of feed gas on Tuesday. While this development lends some support to prices, it's premature to conclude if it signifies a lasting change in market sentiment. Current weather patterns indicate strong high pressure across most of the U.S., with temperatures in the 90s to 100s, driving significant demand. However, a cooling trend is expected from Wednesday through Sunday in the Midwest Ohio Valley and Northeast, which could reduce demand in these areas. Meanwhile, the European natural gas market is facing difficulties, with imports dropping nearly 12% in the first quarter of 2024, compared to the same period last year. LNG volumes alone decreased by 11%, reflecting broader market uncertainties. Despite present market challenges, some energy executives maintain cautious optimism about future prices. The Federal Reserve Bank of Kansas City's survey suggests that natural gas prices are expected to reach $3 in 6 months and gradually rise to $3.90 over the next 5 years. While recent developments in LNG exports provide some support, the natural gas market remains in a transitional phase. The slight increase in futures prices hints at a potential bottoming out, but persistent bearish factors including weather-related demand fluctuations and ongoing supply concerns continue to apply downward pressure. Monday's sell-off may have forced the remaining stubborn longs out of the market, potentially initiating the bottoming process. The first indication of a bottom will be breaking above yesterday's high of $2.27. However, as long as the market stays below the $2.50 resistance reinforced by the 50 and 200-day moving averages, we will continue to be in a sell the rally mode. As I said in yesterday's analysis, a dip below the psychological $2.20 level will attract buyers' attention, and we are witnessing this process right now. Please like, subscribe, and comment to support the channel. See you in the next one.